This was really funny. I saw a survey the other day about what some of the largest banks in the country are paying on one-year CDs. And you're not going to believe this. 1/100th of 1% and 3/100ths of 1% on one-year CDs. It's some of the, what I call the giant monster mega banks. I mean, come on. And we are at a tipping point. I talked about this like 6 weeks ago. You may or may not have heard me talk about it then, but we're really at that curve. So inflation is not what I'd call under control, but the trend is completely clear. And those of you who weren't sleeping through economics, you know about disinflation, which is the rate of inflation is coming steadily down. Some categories we are in what's known as deflation, prices dropping, but then others, prices have stayed stubbornly high, like we talk about the supermarkets. And even though the prices are high from where they had skyrocketed to, they're not really rising any meaningful amount now, but they're already much higher, which is why people are so dissatisfied with what they're paying. But it's clear from what the Federal Reserve has said and the inflationary trends, or disinflation, is that interest rates are headed on their way down. And I was looking just now. So what's funny is there I'm telling you about how the wonderful giant monster mega banks are cheating people by paying at a time that online banks are paying consistently over 5% on one-year CDs. 5.5%, 5.25%, but somewhere around in that range, 5.25% to 5.5% tends to be where the online banks are offering. By comparison, Bank of America, 3/100ths of 1%. Seriously? Chase, 1/100th of 1%. Now, let me tell you, if you have a BOA credit card or a Chase credit card and you're running a balance, they're not charging you 1/100ths of 1% or 3/100ths of 1% in interest. They're charging you 20-something percent likely. I mean, it's crazy. But customers of big banks just let their money sit and allow themselves to be taken advantage of through inertia. Move that money. You can look, we have a list at Clark.com. Bankrate has a list. There are a number of lists. You can see the best rates right now on CDs of various lengths. The other thing, and I realized I didn't mention this 6 weeks ago, the value of looking, if you're a customer of Fidelity, Schwab, or Vanguard, looking at any of those three as the place where you buy your CDs through what are known as broker-placed CDs, FDIC insured, and often those rates will be higher than what you're going to find even with the typical online bank direct offer. But the 5-year CDs that we're paying the most, paying above 5%, in some cases up to 6%, now they've fallen a point below what you earn on the 1-year CD. That's called an inverted yield curve. Why is that happening? Because the marketplace is pricing in, Wall Street is pricing in, that we are at peak interest rates. So longer term money is now earning less than shorter term money. But if you have money that you don't need for a while, I love the ladder. The ladder is where you take your money, divide it into 5, or at least 3. If you do 3, you take a third of your money, put it in a 1-year CD, a third put it in a 3-year CD, and a third put it in a 5-year CD. So you're playing shorter term, mid-term, long-term. A classic ladder is you buy 5 CDs, 5 different piles of money, 1 year, 2 year, 3 year, 4 year, 5 year. so that you're spreading out your risk of time versus the reward of the interest you can earn. So this is a time that's really good for savers with money you don't need immediate access to lock it down. Not as good as it was 6 weeks ago, but still, this curve is turning. So it's very much to your advantage, particularly with longer term CDs, to get that money locked away. Now, there is another thing for people that are more investment oriented and need money in the equivalent of savings kind of instruments, which would be the closest equivalent, but with risk to your holding, is bond funds. And there's a lot that's been written lately about how for people in higher tax brackets, there's now advantage again to looking at tax-free municipal bond funds. The king of that is Vanguard. And they sell a variety of tax-free municipal bond funds. Know that if you buy one, buy a short-term, intermediate term, long-term, a mix of those, you'll be exempt from paying tax on the earnings at the federal level. And you have the upside benefit potentially that as interest rates do decline, the value of the bond funds goes up. You also have the risk that if the market's wrong and interest rates rise, the value of your holdings go down. So this is more for people that are of an investment mindset, and especially people in higher tax brackets, than it is for people just looking to do run-of-the-mill savings. But here's the rule. This is when you want to have your money in either one of the 4 giant monster mega banks or what's known as a super regional bank, the big regional banks, for CDs and savings accounts. So the 4 giant monsters are Chase, Citi, Bank of America, and Wells Fargo. And then you've got a bunch of these super regionals. When you want to have your savings or CDs with any of them is never. CDs, never. Savings, never. Because they will rip you off.